Hello everyone. Today we are going to talk again about fundamental analysis. Recall on the previous session we spoke how to implement tools of fundamental analysis into stock market, evaluating stocks and intrinsic value of stocks. Today we are going to focus on implementation of fundamental analysis in the Forex market, as this proved to be more popular and nowadays, and the number of traders are always looking for the best information about direction of desired currency pair or commodity. So the fundamental analysis is a part of the complex of two main analysis used to analyze the movements of the market and of course predict the future action of desired currency pair on commodities. So it's one of the two main methods in evaluating and forecasting future price movements. This is what traders are basically looking for. And of course, it's applicable to all financial assets. This is what we already mentioned in our previous session. Compared to technical analysis, which evaluates previous movements, and by using technical tools, which we are going to talk more in our coming sessions, fundamental analysis depends on the current, of course, on historical data, but on the current issue. So the release of the certain economic indicator or news is directly affecting the market movements and directs the currency pairs or commodities. As we said, the main aim of fundamental analysis is to determine how the currency or commodity will react to certain releases of macroeconomic events, such as economic indicators and the news. Again, we have a number of news that are coming and directly affecting the markets, and most significant recently were geopolitical news, and we are going to elaborate this also. So the first important thing out of 4 or 5 top subjects in fundamental analysis is the monetary policy decisions of the central banks. We all know that central banks are creating their policies and moving the interest rates according to the current situation of the economy. So it's closely watched. We have a sample now with the U.S. Federal Reserve. The head of the Federal Reserve, Jerome Powell, last night, and his tone was slightly dovish compared to the previous talk at the beginning of October, saying that current interest rate level of U.S. Federal Reserve is close to the neutral zone, which is projected by the central bank on 2.5 to 3.5%. This is coming as a much softer tone compared to the previous statement, when he said that there is still a long way towards the neutral zone, and this is a sort of hint to traders that U.S. Central Bank may pause or at least reduce pace of increasing interest rates, as they already increased interest rates 3 times in 2018 and looking for another hike in December this year, and probably another 1 or 2 in 2019. But now the question is whether they are going to do it or not, due to current situation in the global economies and the fears of slowdown of global growth. So monetary policy is one of the closely watched events that affects the markets, and we can take a quick look at the movements of the major currency pairs on Wednesday evening after the Fed Chief Powell spoke, and he said that what he said about possible reducing pace of hiking interest rates in the United States, and this was the reaction. The dollar was sharply lower, as of course this is the domestic currency of the United States, so it's the first to react, and the US dollar was lower across the board after the comments of Mr. Powell. This is the chart of euro against US dollar. We can see the sharp move within 2 hours when the euro against US dollar rose over 100 pips. So this is a good sample showing how the technical analysis, fundamental analysis affect the market on release. We didn't have a release, we had the news, but it falls into the same group. So reaction of the market was quite strong and was immediate as investors got in a way disappointed by quite softer tone from head of the central bank, and this is not good for those who were counting on a stronger dollar on increase of interest rates. So a softer tone from central bank means that they are not willing, or they are not planning to increase interest rates, or at least not at that pace that was initially expected. So immediate reaction was to get rid of the dollar, and its so-called risk appetite increased. The traders were looking for more riskier assets jumping from the dollar. The next one is inflation. We're going to elaborate each of these events later on during the session. Then we have gross domestic product, labor sector data, and as well the political and geopolitical news. These first 4 points are the key points of each economy. So we will be focusing on the most important, although there are plenty of economic indicators that more or less affect the market movements and move the currency pairs and the commodities after release. So focus is on these things. Of course, a number of other economic indicators, and they are classified also by the strength of the impact. We will see later on in a sample of the economic calendar how it looks and what could be the expectation, as the calendar gives a quite accurate picture of what to be expected on the release of certain economic indicators. So we have a graph, we have a picture here which shows as a central thing is our goal or our target to create the Forex trading strategy, to define and determine how the market will be moving and what will be levels to watch in direction. Of course, first with all surrounding events that are helping to make our decision, our trading decision. So as we said, we have economic data as one of the top things. Global environment also, including all news from the world, political, geopolitical, interest rates, inflation, and political events. So all together give us a sort of more clear picture in making our decision to make the trade. As we previously mentioned, fundamental analysis is a tool that helps traders to estimate the strength of the impact on release of indicators, economic releases, and the news could have, meaning that a stronger impact, which also depends on the strength of the indicator itself. So it cannot be, and usually it's not the same impact on, let's say, US non-farm payrolls or increase of interest rates with some releases from the manufacturing or services, which are also important and strong, but there is certain there are certain levels of strength of each indicator, and of course it gives us signal of the length of the action. Is it going to be sustained or is it going to be temporary action? Sometimes markets, what we talked on the previous sessions, markets work on a rule by the room or sell the fact, meaning that before the release, market, the instrument desired that we watch, let's say, goes higher, and then upon release it reverses back to its original levels. So traders basically build the price before the release, and the release comes as a trigger for taking profit. But in case that we saw recently on the graph of euro and US dollar, the move seems to be sustained for now, as euro holds near highs after Wednesday's rally, and meaning that sentiment has significantly changed, as the single currency was in downtrend in past couple of days, and the comments from Fed Chief Powell were seen as a catalyst for something new, change of direction. We can take a look again on the daily chart of Euro-US dollar, just to illustrate this sample, how the how the economic indicator affects the movement. So we had the sort of downtrend in the past 6-7 days, and Wednesday's move after comments from Fed chairman signaled the change of of the direction, as the move today ticked a bit higher, hit 1 week high, but is still showing vulnerability, and it may return lower in case if other factors come and influence the single currency's recent strength. And now we're talking about something else that is coming. We have a good sample tonight, release of minutes of the last policy meeting of US Federal Reserve, which was on 7th and 8th of November. And usually this shows the mode or the mood of the Federal Open Monetary Committee, who decides about the interest rates. And will give us a clearer picture whether they are counting on a more aggressive approach towards the end of the year, at the beginning of 2019, or they are going to reduce the pace due to some factors that are influencing the markets. As fundamental analysis is a quite complex study, and includes a number of other important factors. So we may have sometimes releases clashing each other, or simply coming in the opposite way. So the one that is stronger will usually dominate. Usually the sentiment will be following the stronger release, the more important release. So in any case, by using fundamental analysis, we can estimate the strength of the impact upon release, and as well as length of the action that will be following release. Fundamental analysis apply on all releases. So we have country of origin, let's say United States or United Kingdom, when release of fundamental of economic indicators or news applies directly on the currency of the country of origin. In this case, we're talking about US dollar or British pound, but also affects their counterparts and shows the stronger or less strong impact depending again on the strength of the release. And we have another case like euro, which is a common regional currency, and then we'll be looking for releases from each member of the Eurozone as a block, and of course we'll be looking as the block itself. So the Eurozone itself has economic indicators, while the member countries have another releases. Altogether combined, give us a clearer picture. It's important to mention that the strongest impact in Eurozone comes from the biggest economies, which is Germany and France, as well as Italy, which is the third biggest and strongest economy in the Eurozone. But Germany has a sort of priority, and the strongest impact on the market comes from releases from Germany, apart from releases from the European Union itself. And the market reaction now depends, as we said, on importance of the release. And usually stronger reaction will be on key macroeconomic data. This includes our key points that we mentioned previously: interest rates, gross domestic product, inflation, and data from labor sector, as well as geopolitical data. And if released numbers of economic indicators come well or below forecast. So it is important to watch the forecast itself. Usually the polls of economists give the forecast for the coming release, and this is our initial indication how the indicator would behave on release. Of course, and not necessarily that it will be released at levels that are indicated, but it usually not always happens, and then release stronger, well above or well below, indicates the impact and the direction. So it's very important to watch how it behaves. A good sample we have, let's say, from a release of U.S. non-farm payrolls, when last month or 2 months ago it came in significantly higher number than forecasted. But another factors that were watched did not follow. So average earnings stayed at a lower level, and this in a way reduce the impact of the stronger data. So this is what I mentioned previously, that we have to combine all the releases and other factors that are surrounding in order to get the clearer picture. So the fundamental analysis evaluates the impact and determines the direction and expected levels of the currency pair after release of economic indicator or news. Let's have a few words about news and geopolitical data. Remember the case with North Korea last year, when they used to launch missiles every weekend. And the market was upside down on Monday opening. So the markets follow these things, and this is also one of the important segments of global markets and the reactions of the markets on all these news. So we had repeatedly every Monday, and on opening there were gaps higher or lower, depending how the market sentiment will be and how markets will be reacting, because market participants also estimate what kind of impact will be. And usually the first to react are US dollar and the so-called safe haven assets, which includes Japanese yen, Swiss franc, gold, as well as crude oil as one of the instruments that is sensitive to geopolitical events. And news are usually having also almost equal impact on the markets upon release, like the key indicators. Of course, strength of this news, it's directly connected to the market reaction. But in any case, we have to mention that it's one of the key points that needs to be watched in order to estimate proper direction. The other good sample is recent tensions between the United States and China over the tariffs that United States want to impose on the imported goods from China, and the initial decision on 10% has been increased by President Trump to 25%, and this is quite a strong signal that something might happen in the world market if this will be implemented, or the agreement will be found and they will drop this decision. So in both situations, we have expectations for strong reaction. There is a G20 meeting on starting from tomorrow in Buenos Aires in Argentina, where all the top world leaders will meet. And of course, the focus is on the meeting of President Trump and the Chinese president, who are going directly to talk about the current problem with the trading issue between two countries. And expectations are approximately half-half for finding solution or increasing. Recent comments of President Trump, which were released 2 days ago, pushed the markets lower, as he said that they are going to proceed with increasing tariffs on the Chinese imports, while the other half, let's say other half of the market participants still hopes that a deal will be found, because increasing or increasing of the current situation, which escalation in the trade conflict is not good signal and would pull all world in the further turmoil, and that this will not be good for economies as big ones, also smaller ones, even with the stronger impact. So there are hopes that it will be solved, but there are also expectations that US will proceed with their decision to increase tariffs. The other thing important also to mention, crude oil. We had in the last session comments about crude oil, which is in strong downtrend on very strong negative sentiment triggered by fears of global oversupply, and of course, and also forecasts for demand for 2019, which show expectations for lower demand, meaning that there will be oversupply of the oil, meaning much more oil than needed, so the price will automatically go down. On the other side, we have a clash between the United States and another key producer, Russia and Saudi Arabia. As President Trump urged the OPEC and particularly Saudi Arabia not to decrease the output of the crude oil, as they signaled the last week that the OPEC itself, along with Russia, will come with the decreasing production by initially 500,000 barrels per day in order to stabilize global oil market, while on the other side, Russia and Saudi Arabia want higher prices of the oil, not too high, but something between $75 and $80 per barrel, which is the latest comments in the market. So we have another clash, and all eyes are turned towards G20 meeting in Argentina, which will likely give more hints about future movements in the world in light of current trade conflict between US and China, as well as the direction of the crude oil, which, by the way, broke below psychological $50 per barrel today. We're talking about US light sweet crude oil, while Brent oil is also significantly lower. And economic indicators, these are the things that we were talking previously, releases, and it says by definition it's a piece of macroeconomic data released by government or other non-profit organizations which are dealing with this and indicates the direction of an economy. We have the three main categories of the economic indicators. Leading indicators are those who show signs of improvement or decline in economic conditions directly, so money supply, factory and equipment orders, consumer expectations, jobless claims, coincident or current ones that represent current economic activity, and lagging indicators emerge after change in economic situation. Sample is, let's say, unemployment rate will start to decrease after economy growth accelerates. So we need first to see the increase of in economic growth in order to trigger slowing down the unemployment rate. And we can see also the slide here that shows how they are divided. Economic indicators are important as these are the key indications in the fundamental analysis for traders to estimate how the desired currency pair or commodity will move upon the release. The actions of the monetary authority, we have the first one monetary policy of the first of the group that we mentioned previously. So we have monetary policy, GDP, inflation, the labor market as the key events for the market, those with the strongest impact in the market after being released. And it's the action of the monetary authority of a country, which is usually central bank or committee, like Federal Reserve has the FOMC committee, which deals with interest rates, to determine the size and the rate of growth of money supply, and of course to decide about interest rates. Now we have two monetary policies: expansionary, which increases the money supply to boost the economy, at the same time boost the consumer spending and employment, and contractionary aims to contain rate of growth and inflation by increasing interest rates. And of course, this one has some negative impacts reflected by a slowing economic growth and increasing unemployment, but it's good to in a way control and reduce the strong inflation. We have good samples for both of these types. Expansionary policy was widely implemented during the crisis, which started the global crisis in 2008, when all the major central banks of the world continued and kept for quite a long period. Some of them are still holding ultra low interest rates, pumping money in the market in order to keep it afloat as the crisis impact of crisis increased. So the central bank was central banks were basically trying to balance the situation and wait until initial signs of improvement come, then they can change their policy. And in addition to expansionary policy, we have something new that was implemented after the crisis started in 2008. We have so-called unorthodox measures, which includes these quantitative easing, when the central banks are pumping money in their economies by buying government bonds in order to keep the economy afloat. On the other side, contractionary policy, as we said, contains rate of growth and inflation by increasing interest rates. We have a Turkish economy as a good sample. Turkey central bank was trying to fight very strong inflation, which is a double digit and is around 25%, while Turkish lira fell in the same way to its lowest historical low against the US dollar, and there was sort of hesitation and political lacking of political agreement to act properly. And the latest action of the Turkish central bank in September, when they went more radical and increased the interest rates well above expected levels in order to keep it close to the inflation level, which is in a way unpopular measure, but it gives results. And as a result, we have Turkish lira first stabilizing, and now it's in a steady ascent. We don't know how long it will last, because we'll have a release of Turkish inflation next week, and this will be indicating the next movements. Again, fundamental analysis. So these two are the main policies that are included in operations of the central banks, and reflect on the release of economic indicators, as the monetary policy is one of the important things. So we have a picture here that shows how it works. So monetary policy depends on inflation, on money supply and interest rates, and then all these factors create a final decision of the central bank in creating its monetary policy. As said, we have a number of other factors that are involved here, so all needs to be considered before the central bank makes a decision. As I mentioned previously, U.S. Federal Reserve were quite aggressive in increasing interest rates in past 2 years, as the United States was the first big economy to emerge from a crisis following stronger and much better than expected economic data from various factors, which indicated that a crisis was behind, and the central bank is coming back to its normal operations after being in sort of hibernation for almost 10 years due to the global crisis. Now, the question is whether they reacted too fast or not, because the world is not recovering at that pace like United States, and we have, as I mentioned, a number of key central banks still keeping ultra low interest rates and still pumping money having so-called quantitative easing in order to keep economies afloat, awaiting for, let's call it better time, when the stronger signals of recovery will be received, and then the central banks could start talking about increasing or changing their policies. Now this triggers also the divergence in interest rates between the US and the rest of the world, which also triggers friction in the market and the stronger movements. As the difference, traders also play on this difference and try to capitalize maximally from such a situation. So we have a number of factors that are influencing the monetary policy, and all need to be considered before the central bank makes decision. As mentioned previously, Federal Reserve will release tonight the minutes of the last meeting, and this will be quite a good indication of the future and next steps, as there are quite strong signals in the market that global economic growth is going to slow down. Most likely starting from beginning of 2019 on various factors, and one of the key factors is the current trade conflict between the United States and China, which threatens to increase, to gain pace and the spread, and that would have a negative impact on the global economy. And of course, reducing pace of growth would also affect the action of the central banks, and that's one of the reasons that U.S. central bank is rather cautious at this time and wants to take into consideration all factors before making decision. Despite that, there was quite strong, and there is still quite strong expectation in the market that the U.S. Federal Reserve will act and increase interest rates for the fourth time in 2018 in December's meeting. But now there is a question mark above this. So that's the reason we are following the economic indicators releases to estimate whether these things will happen or not, and how strong impact will be. The next one of the pillars that each economy stands is the gross domestic product, so-called GDP. This is the monetary value of all finished goods and services in the country in a specific period of time. So whatever one economy produces, goods and services within 1 year, let's say, it's indicated, is presented as its gross domestic product. Of course, releases come in monthly and quarterly. Usually the most significant are quarterly releases. So it could be compared how the economy was behaving, let's say, in the second quarter compared to the third one, or the fourth quarter compared to the first 3 of the year, and can estimate whether economy is expanding or contracting. A series of lower than expected releases signal that the economy is contracting, and then certain steps need to be taken to in order to prevent deterioration of in the economy of the country. Or if it's expanding, that's a good signal. We had the number of signals in past 2 years from and still coming from United States, when it showed that the economy is greatly recovering after crisis which lasted almost 10 years, and this is good signal for central bank and for whole economy. Components of the GDP. So let's break it into pieces. We have personal consumption expenditures, investments. Now they're split into other things, inventories and fixed investments, and then further down on residential, then government's expenditures, so whatever government has spending and costs, and exports, net exports, which include exports and imports of the country. So sum of all these factors will give us value of gross domestic product for a certain country in the given period of time, and then we can estimate how the economy is behaving. Is it contracting or it's expanding? And we have a graph of United States gross domestic product. This is from 2008. It's interesting to see how the economy was improving after crisis started in 2000. then dropped to the lowest in 2009, and then steady recovery started. Despite the crisis was still biting, economy managed to recover greatly and hit the highest level in 2017. This is until 2017. So this illustrates what I previously mentioned, how the gross domestic product is affecting the other sectors, and how they are all connected when certain key decisions are due to be made. Now, the next important thing is data from labor sector. You all heard unemployment, employment, jobless claims. So these are the things that are quite important in the market, and every release has its significance and affects the market. So we have first unemployment. This is one of the key indicators of the situation of the economy. Unemployment simply is a number of people who do not have job, who were actively looked for work in the past 4 weeks minimum. So this is then they fall into this category, and currently are not working and are available for work. So statistics calculate unemployment by this, and the calculation is simply number of unemployed people divided by number of employed people, which gives us unemployment rate of the country for the given period of time. Of course, higher unemployment means that the economy is not doing well, while stronger employment and increase in employment. Of course, we need to consider also the wages, income of people, because simple increase of employees, of number of people employed, not followed by increase of the income, means that it's not sustained increase. So it is sort of a negative signal. This is what I mentioned previously. So if the increase of wages of income does not follow the increase of employment, it means that something again is not functioning as desired. And then employment rate is also important to mention, as I said, a higher number of employed people means there's steady economy, and we have a good sample of United States where employment is at full. They have so-called full employment when number of employed people reach the level projected by the government or ministry or labor office that is in charge. So when this is done, then we have the first of major requirements to determine that the economy is doing well fulfilled. The impact, this is what I already mentioned. Stability of the economy rests on the ability to maintain low unemployment and provide a safe, secure workplace. So, in other words, less unemployed people and more employed people are positive signal is the simplest to explain. And employees need to benefit from workplace, and of course to produce some money to the businesses. With the economic growth increases labor demand. This is what we spoke already. I mentioned the results. Economic growth triggers labor demand. This is a lagging indicator, so it follows. First, we need to see increase in economic growth, which will trigger higher employment. But at the same time, this also we mentioned not necessarily the higher income of employees, which creates another story. Now we have a picture of U.S. non-farm payrolls since late 2017 until October 2018. We can see significant jumps into monthly results. This marks the number of people employed outside the farms and the households and private sector. So basically governmental jobs in a way, to simply explain. And there are some seasonal adjustments, seasonal requirements for more or less labor. So this gives us this choppy range, but main indication from the labor ministry is holding above 100,000 release is something that is supportive and it's acceptable, which will keep the overall picture positive. Any drop below 100,000 will be already alert for the relevant bodies and will signal that pace of employment is reducing. But U.S. non-farm payrolls is one of the key events in the market, and it's closely watched. It's going to be released at least next week, in the first Friday of the month. So markets are awaiting, already commenting what could be the expectation and impact. Of course, we need to take a look on the whole picture. So the non-farm payrolls report includes these non-farm payrolls, but also includes the income of the employees as well as unemployment rate, and combination of these indicators gives us some more clearer picture about employment. The last but not the least important factor is inflation. You all heard about this. It's basically a quantitative measure of the rate at which the average price level of a basket of selected goods and services increases over a period of time. And in simple words, it's the cost of this sample of goods and of the basket of goods, pardon, and it indicates basically decrease in the purchasing power of a nation's currency if the inflation goes higher. As prices raise, they start to impact the general cost of living. So these are the impacts of the higher inflation for the common public and the appropriate monetary authority of the country, such as central banks, and it takes the necessary measures to keep inflation with some acceptable limits and keeps the economy running. So this is what we mentioned about expansionary, about monetary policies, which is directly connected to the inflation. So contractionary monetary policy works in order to control or lower inflation when it comes to the high levels. So there are always tools that handle situations like this when inflation is high. In other words, simpler, inflation is when a certain form of currency start to have less value over time. So if you buy certain product for a certain amount of money once, twice, and then third time you need more money, so it means that inflation is going higher. There are two things that cause the inflation. First is generally people's perception of value. As they estimate that something could cost higher, then they push the price higher. And the economic principle of supply and demand, which is one of the key things to impact inflation movements. So this is working basically like market on the main points such as supply and demand. Now we have three types of inflation. First one is demand pull inflation. And which comes there is strong, if there is strong demand for certain goods, the price will of course go higher, and at the same time there is low employment, so there are initial signs of crisis in the economy. Cost push inflation is the one caused by certain decrease in supply of certain goods, which have immediate reaction in increase in goods prices. So, for example, we spoke about oversupply in the oil. The prices of oil were sharply and still sharply down. In the opposite situation, a lower supply, meaning that there is a lack of product in the market, in this case oil, would push the price higher, and it will increase the inflation. Producers for these goods which are a deficit, let's say, will increase the cost and could then pass it to consumers in the form or increased prices, meaning that inflation will go higher. And anticipated, this is the what we mentioned, the prices just go higher because people expect them to rise. People expect something to be more expensive, and stronger demand. Again, we come to supply and demand that pushes the price higher. Now we have a sample of the economic calendar, which gives us the date, the time when it will be released, the country of origin, and also important thing is this icon here, which gives us the strength, expected strength of the indicator, and meaning that stronger in the indicator with 3 lines, let's say, has the top impact, is expected to have the strong impact on the market. And usually these are the indicators that we already mentioned, such as GDP, interest rates, job sector data, and inflation. These are the key things, and you can see from the calendar that GDP has the 3 lines, while others, producer price index, let's say, has 2. So it is important, but less expected impact based on compared to the GDP or CPI inflation from United States is also the highest importance in the market. Now releases, we have the poll here. So these are the expectations, and we have actual and surprise. So this is basically when it's released, you can see it, some calendars show it in different colors. So if the forecast is 0.6% and the release comes at 0.8%, some calendars will show it in green, meaning that it came above expectation. So it's in a way positive, while negative will be if it comes below expectations and will be colored in red. And then we have surprise, also important point when it shows us the strength of the price. So if, as what we spoke previously, if the price drops significantly below forecast or goes well above forecast, that's surprise. So the strength of the surprise is directly connected to the strength of the reaction of the market, triggered by release of the economic indicators. And of course, it's always a focus on those so-called key indicators, the most important, those that have the strongest impact on the market. And a number of traders use the economic indicators as a trading tool. So they are so-called economic indicators traders. This is something that is rather popular, but has a lot of it has a lot of it's basically quite dangerous. So some traders simply just trade the releases. They are not anticipating any trends or anything, just going for release and expecting that market will go in the desired direction after release based on forecasted levels. So they can catch some moves, but in case of a negative surprise, they could be easily caught as usually reaction of the market if it's much below expectations. So negative reaction could be quite strong and poses a strong risk to their investments and their trading accounts. So it could result in some bigger losses than expected, and that's why this is the subject of some next sessions when we'll be talking about trading strategies and trading discipline.